you should play the market if the capital is available. See, I can't find fault with the founders and who raise a lot of capital and try to grow very fast in 2021, because if you don't do it, your competition will do it and you will become inconsequential. So it's very easy for us to say that, oh, you didn't build a good business, you went all over the top. But that is how the market was forcing them to behave. But today the good thing is that market is forcing them to behave enough, to build something which is fundamentally strong. And this is good foundation. If this is the foundation, then over time, kind of they will be able to they're better equipped to use capital when it comes along.
Hey everyone, this is Prashant and I'll be your host of the VC 10X podcast. And today we have Amit Singh with us. Amit Singh is a co founder of Misfits Capital. Earlier, Amit had founded Shuttl, an app based commute service for office goers. Amit has invested in several startups. In this episode, we talk about story of Misfits Capital, how is Misfits different from syndicates on Angellist and Let's Venture, how they evaluate startups at Misfits Capital, why founders need to play the market, and so much more. So, without wasting any time, let's dive straight in. Hey Amit, so good to have you on the VC 10X podcast. How are you doing?
I'm doing very well, Prashant. Thank you so much for having me here.
Yeah, it's a pleasure having you on. So, to start things off, can we first talk about your story and why you started Misfits Capital?
Yeah, so it's 17 years ago I started with private equity, just fresh out of B school, and I thought this is a great job, pays 2x of the market, gets you talk to promoters, and this is late stage, so we used to call them promoters, not founders at the time. And you get to do whatever you want to do, you know talk about strategy and all those things early in your career. I thought this is what I want to do for the rest of my life. uh, but over the years, I was there for 5 years, but over the years few realizations happened. One was that whenever I was talking to these founders, I felt like I should be on the other side. Why am I not building, and also somewhere, I realized that I was not building those skill sets. I was not hiring people. Like you don't need big teams in private equity. I was not managing people. Uh, I was rather living on borrowed knowledge. Felt shallow at some point. I didn't want to grow into that. So I thought maybe kind of this is too early in my career that I'm getting to private equity. So in 2012, I moved out, joined Jabong, which when it was getting started, and a whole new chapter opened up for me. I understood what consumer internet is, what product is, what digital marketing is, how to build companies, how to hire, everything. Kind of I learned pretty much there. And it's been 12 years since I've been in and around startups. I built Shuttl, raised from the who's and who, and eventually sold it also. And then the question was, kind of what next? So I tried few things, before Shuttl, before Jabong, before Misfits, and while they're just, kind of side notes on my CV. There's a lot of effort which went into it, and my realization was that anything that I cannot think intuitively about, I'll not do well. And probably going back to that private equity thing, I had not built companies, and I was asking seemingly smart questions that, kind of what's the leverage, what's the defensibility, and all those things. But actually, they were like pretty much dumb questions. I hadn't done it myself, so I just felt out of place there, and it was not very intuitive to me to be there. So this after this stint and like 12 years in startups, I felt like kind of probably now is the time where I can think of doing startups, building companies, at the same time investing in companies. So where is it that my sweet spot is? And I did realize over the years that a lot of founders had become friends. A lot of friends had become founders. A lot of my teammates started companies. Some are running unicorns, or best of the best have invested in their companies. So and there all those conversations, not just my journey, I have somewhere been a part of their journeys also, and that learning is there. So what's the best way to kind of put it all together? So yeah, so this is the genesis, but I felt that this is intuitive to me now. But at the same time, there has to be you cannot just start something. There has to be a need for that, and there has to be a market for that. So the The reason is, kind of could be my skill sets, could be this, but why we are building is we realize that tech has gone mainstream, uh, but investment in tech hasn't. There are very few listed companies in tech, and by the time they IPO, pretty much kind of it's late in their journey, and share markets are not really they're not going there to really raise capital, but to give exits to the early investors. So by the time a retail investor or a regular investor gets in, it's too late and the upside is rather restricted. At the same time, if we can imagine what can happen in the next 10, 20 years in this whole tech ecosystem, considering where we were when I joined Jabong, let's say in 2012, it's we should have thousands of maybe thousand unicorn, hundreds of kind of baby cons or unicorns, whatever you call them. So all that opportunity is ahead of us, and the private markets have become very strong. Either, but there are only two actors who are benefiting from it. There are two kind of investors. There are angel investors who are very special people. They are like at the right place at the right time with the right checkbook. And then there are these institutional investors or family offices who are LPs in these VC funds, and those are professionals who are investing their capital. But the rest of India is pretty much or that's true for most of the world also, is kind of excluded from this asset class. So in some sense, it's a very exclusive asset class, the startup asset class.
Yep.
So how do you make it inclusive? Now at some point, it's not even like it's not an asset class where masses should be putting in their hard-earned money. It's not even that. It's illiquid. It's risk. You have to build a portfolio. You cannot just take one off bet, and that's like playing lottery. So you don't want to do that. You have to do it in a methodical way. uh, but there is a huge segment of people who believe in startups, who are, who believe in tech, who are users of tech, who are believers in tech. They're bullish on tech, but they're not long on tech. And they're affiliates. They understand, that they need to build a portfolio. They have a certain net worth and all, but they are not getting access to this asset class. So that's what we thought that probably is an interesting problem to solve. So on one side, we are almost like an early stage fund, while we are stage agnostic. But as of now, the market is such that we are mostly focusing on early stage companies. On the other side, we are building a product wherein we are trying to kind of solve the problem of getting affluent India to get exposure to this asset class by bringing in hyper curated deals, helping them with diversification and a portfolio approach. And over the years, they shouldn't miss out on this amazing opportunity to of wealth creation as these tech companies and startups become bigger.
Absolutely, yeah. Very rightly said. Most of the population doesn't have access to this asset class, venture capital asset class, investing in startups directly. And maybe it should be that way, that it's a very riskier asset class. You need to have a complete portfolio in order to have your bets hedged in a way, and then let the power law play out. So you're saying that Misfits is an early stage fund, so you have raised a fund, which is, and
No,
you're
no, 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 no.
no.
So no, we are not a fund. So the way we
Okay.
are structured is, see, we are essentially at the back end. There is an AIF Cat One Angel Fund,
Okay.
uh, but that is an angel fund. So it's not like you need to. It's not a blind pool like a VCF.
Right.
Every time you do a deal, you need to have a consent from the LP, whoever is putting in money.
Right.
So you don't need to raise capital. It's on the it's something similar to how syndicates operate, but
Right.
we are like a digital direct to customer version of a syndicate. So
Okay.
we are like on our platform, on our app, we are the only people who are bringing the deals. There are no other syndicates live here.
Okay.
So we bring in the deals. We completely, we hyper curate. We completely own them. We have skin in the game. We are investing in all those deals ourselves. And for each deal, different check sizes can be raised, and AIF acts as a pooling vehicle.
Got it. And with that, you're building a product which can give access to even retail investors. Is that
No,
correct?
not retail. So
Okay.
retail is a very different. See, one is that it's not advisable, kind of for a retail investor to come in this early. You need to have when you have already have exposure to equity, you have exposure to mutual funds, and you're covered there. you are affluent, you have a certain net worth. After that, you want exposure to another asset class, which can create an alpha for you, because on an average, this asset class has performed well. So anyone who needs liquidity or who needs money at a certain point in time or who cannot handle that risk should not be touching this asset class. And even if you are, you shouldn't be touching it like, I do a couple of investments and, we'll see where it goes. And maybe that's again, trying to play it wrong by thinking of it as a lottery. So the way to do it is probably the how good angels have done, how successful VCs have done, which is always a portfolio approach. And while most of these companies you'll put your money in will not work out, but as a portfolio on the whole, if you follow the right process, the right method, uh, and the way the opportunity looks like in India, the digitization and the technology adoption and everything, you should generate superior returns to let's say the benchmark public markets.
Got it. Got it. And it's a very interesting name, Misfits Capital. So, what's the reasoning behind that name?
The way to think about it is that the startups truly don't have the right to exist because the world is fine without them. Someone is catering to that need that they're trying to solve. So someone has to be really, who's not fitting in, has to come in and try to kind of create space for themselves, earn the right to play, and create a product which becomes big, and we all become users of that. So that's the point here. So it's a tribute to the founders, and we go back to that Steve Jobs speech where he talked about the crazy ones and the misfits and the. So it's in that sense, kind of a tribute to the founders because they are the ones who create value, and we as investors or our users who are like LPs benefit from that. But the value is being created by founders.
Absolutely, very true. And you said Misfits is also a platform. So, how is it different from what Angellist does or what Let's Venture does?
Yeah. So in some ways, we are very similar at the top level, but let me focus on the differences then. So, like Let's Venture and Angellist, they're two-side marketplaces. So on one side, there are users who are wanting to put in their money into this asset class, which is very similar to ours. But on the other side, there are people who are running syndicates. So we don't have that side. We don't have people running syndicates. Our view is that if anyone can run a syndicate on the platform, then it's very difficult for the other side, for the people who are wanting to put in their money to figure out which is a good deal, which is not, and they have to kind of figure out who is the right syndicate manager, who is bringing deals, good deals, who is not bringing good deals. So there's a lot of work that they have to do at their end. What we are saying is, as per us, these are hyper curated deals. See, maybe these companies will not do well, but our we have done enough work before these companies go live on the platform. Uh, so as per us, there are no bad deals. They may turn out to be, kind of bad deals, but as of as on date when we list them, we go through entire process of, how do we be less wrong? What are the filters? What are the F checks? What are the other things that we can do? We do all that so that we don't, kind of list bad deals. So the users get a very safe space. And then there are other filters, there are other users who are investing, and it's more like a social proofing thing. So you get to know who else is investing. You may want to talk to that person, or you have already some belief in their, judgment. So that may, kind of change your view somehow. So all those things are baked into it such that users find it easier to take a call because like and there's a story behind that kind of when we are starting this, uh, the feedback was that we thought that this is a solved problem, and feedback was that no, we are not able to invest in startups, and we kept on saying that there are so many good platforms which are available, and they have done a phenomenal job over the years. They've built trust and all those things. So why can't you do that? So what we realized that these platforms are catering to a different segment, people who are actually angel investors, who have the time as well as the ability to cross-reference a deal, to talk to the founder or someone who knows the founder and all those things. But if you want to broad base it, that that is not what how it works. So how do we create other framework wherein people are able to still invest without knowing the founder? So maybe there is a trust that gets passed on. So let's say if I know you are investing in a deal, and you know that's that category well, then I may speak to you, if not the founder, and slowly we can build conviction around it. So bit of social proofing, bit of hyper curation, bit of diversification, bit of simplifying the the proposition. All those things come together to make it a very different platform. But at the core of it, we are not a two-sided marketplace. So we are manufacturing, not really manufacturing, but we are manufacturing the portfolio. You can say we are bringing the deals ourselves.
Got it. Got it. And I feel that there are syndicates on AngelList and all these platforms, and you could have been one of those syndicates as well, right? Just being a syndicate on AngelList. Why did you not choose that path and instead
Yeah,
build this infrastructure on your own end
yeah, yeah.
and build this platform on your own self? Why that approach?
Yeah. See, I think that allows you to do part of it, and that's where, kind of I agree with you. But if you really want to solve this problem, uh, the way Angel List is designed, it is what it says. It's a list for angels to invest in startups. So uh, the way it is structured is that, okay, there's a pitch deck, there may be a video of the founder, and you're supposed to analyze that and take a call. If we want to build other things which make it easier for people who are not that plugged in to take better calls, it is not going to change that for us. So how do you kind of you can say that the deals can be listed there, but the product cannot, what we are building cannot be replicated there. So that they are designed for a certain intent, and that intent they are solving well. We are designed for a different intent, different TG, and with each iteration, we are learning, kind of we can listen to our users and we can tweak the platform, we can tweak the product, and slowly, like we have a feed. Or just to give you an example, now you can see, okay, who is investing, who is committing to what deal. You can see a podcast we did with that founder, so that snippets of that can show up there. Then something else we get to know about that company, we put in a card there. So these things, or even the companies we had invested in, there's an update there. All that comes into that feed, so you are able to see it very differently. It's a more social approach towards the whole thing. So there is no way we could have done those things there. And that's the reason, kind of, if it was a solved problem, honestly, I wouldn't be doing it. Why would I kind of even? So I didn't want to just build a fund, or a syndicate. I wanted the problem I'm trying to solve is that there are people who are bullish on tech, but they're not long on tech. How do you bring them into it? Today, the LPs are like family offices or financial institutions, pension funds, those kind of folks. But there are a lot of people who are a little below that, or they're HNIs, they have a lot of net worth, but they do not have access to this asset class. So how do we bring those folks into it? The only way they can do it is maybe, in some new fund, they will have an opportunity to become an LP. But those new funds also kind of, the big funds, the better funds will probably say that we have a minimum check size. Plus, it's a blind pool. You don't have any right here. What we can do is we can create a lot of flexibility for the user. Like while they can decide the deals they want to opt out of. All deals are good, but they can have their view on certain deals, certain categories. So they can decide which they want to get in, which they don't want to get in. So all those flexibilities also we are able to build. At the same time, we are able to simplify the process. Some of these things can be, once you see it, you can feel it. But yeah, it's quite different that way.
Yeah, understand that. That's great. So you're saying basically that all deals that you are showing on the platform are actually pre-vetted deals that are good as per you, and you are going to put your money in as a GP, but it's up to the members if they want to put their money in or not, based on maybe
Absolutely,
social proofing and what's there on the platform, right? Awesome.
absolutely.
Got it. Got it. Got it. And when we talk about how are you deciding which deals get to be on the platform, that means the good deals. So how are you deciding those good deals? What's your investment thesis there? How do you evaluate for that?
Yeah. So, see, early on, we also try to kind of bring deals where there is a tier one investor, some high quality angel, or some VC also is coming in, because they're also kind of doing their work, and that helps us, in the filtration process. So a lot of these have high quality co-investors. Uh, but when it comes to us, our approach is slightly different. See, we're founders, and kind of in some way. Uh, what has happened, what this founders don't have a straight line journey, right? They have their ups and downs and they have struggles and all. So over the years, what we have built is this ability to somewhere figure out whether it is doable or not, which probably someone who has not built companies, no disrespect for anyone who is an investor without being a founder, but their strengths lie elsewhere, or like strengths lie in this thing that, from outside they look like, okay, they are equally good opportunities, or, the TAM is the same, the willingness to pay for the consumer is there, but where does the story becomes different is how we can understand the founder mindset, whether the founder has the right user insights, whether the founder is able to have product thinking. So we are very, very focused on user insights and product thinking. In fact, part of it is about the thesis, which is strong, which I already mentioned, that where founders have user insights and are product thinkers. Part of it is in the process, and the process is that we sharply focus on these things in our conversation. Rest of the things we do our own research, but in the founder conversations we just focus on these. Rather than talking about 10 things, we talk about this one or two things, and then we don't get into a meeting with a hard stop in an hour, which is how we see calendars are. What it does is, in the first hour, sometimes you get to know, okay, this is not where we are going ahead, so that you can you can cut down the meeting wherever you want to. But if you are not able to figure out whether it is worth doing or not doing, you can keep extending that. You can do a 2 hour meeting. Yeah, I've done 4 hour meetings also. I don't get tired. I just enjoy this. And what it does is, with first hour, if founder will tell you what he or she is telling everyone, because it's, but we are focused on one area, so we end up getting more out of that. But with each hour of extra time that we have, we are able to get deeper into uh, the whole understanding of the product that the founder has, of the users and all. And you can you can fake passion, you can fake resilience, you can throw some attitude and all those things, but it's very hard to fake insights. It's very hard to sustain yourself for 3-4 hours on a narrow topic about your user. And our belief is that, see, what is a company? Company is essentially where people are willing to pay for something and have the ability to pay for something. So that comes that they're selling a product where this thing is there. That product, before that product comes the offering. What is it like? Even before the app and all is there, what is the jobs to be done kind of a thing that is happening there? But even before that, there is the user. And if there is, the user is not really thrilled about your product, the doesn't, and users either pay with attention or with money. And if you don't see signs of that, then none of the other things, the TAM will not show up, the GTM will not matter, because there will be churn and all those things. So we kind of focus on the core, which is the user. Is the user really, really wanting this product? And what are the early signs of that? And then we go deep into that journey, and it comes out, kind of, a lot of times the product is not ready or the GTM is not in place. But if the founder is able to kind of articulate that and kind of bring out those insights which are like uh, new to us also, and kind of which is like not market understanding, then we know there is something here. And this is true for early stage. For early stage, this approach changes, but I think that's where we have an edge. We just go overboard on one thing.
Got it. Got it. That's interesting. And now let's talk about how are you sourcing these deals? So how are these deals coming to you and then you're evaluating?
Yeah. So see, why we should, it's about not sourcing deals, it's about sourcing quality deals all the time. Like, what are the best deals in the market? And at some level, we start with this assumption that why should we not get the best deals? Maybe we've spent time in the industry, so we know. As I was saying, there are a lot of founders who have become friends, a lot of friends who have become founders, teammates. So there is pretty much every founder we can get to in one or two calls, is just one or two calls away in that sense. So if you think about if you break it down, like if I think like a product person, I try to break down sourcing. Then there are three aspects to it. First is information or awareness. Is there a deal? Where is the deal? Who is raising? Who is building? That kind of a thing. So after information comes, you can call it conversation. That kind of, now that we know, but is the founder willing to talk to us? And do we get a meeting? So can we get a conversation? And if we can get a conversation, then thereafter, can we get an allocation? founder maybe already there's a tier one VC who is kind of already committed. Why would they kind of talk to us in that sense? So information or awareness is, we are very plugged in. Plus, we have a community of 600 paid users who are from the industry only. They are investors, they are LPs, they're the users, but they also kind of working in some company. There's a product manager somewhere, CXO somewhere, founder somewhere. So, and we have a scout program, so they are able to kind of point us to the deal. They're not getting us an allocation, but they're able to point us. Now, all the goodwill that we have created over the years, it's not that we just, were born yesterday. So all that goodwill is somewhere coming to play, wherein we are able to get access to the founder. They're always willing to have a call because we've built companies, we have done, raised capital and all that. And during that meeting, I think the conversations with us, and partly because how I explained it to you, that we are focused on the product and the user and the way we are going about it, they see something different. And that's our goal, that in that meeting, we should learn because every founder comes with their own thesis and there's so much to learn from them. At the same time, are we able to ask very sharp, pointed, authentic questions, which makes them think differently, which makes them realize that, oh my God, this is not how anyone else is talking. This person I need to have on my WhatsApp. So if we can earn that, uh, then kind of founders won't have to see founders even if you're getting capital. See, we are not saying that we at the end of the day we are giving them money only, and everything said and done, founders want if they're raising 1 million, they can raise 1.2 million. If they're raising 5 million, they can raise 5.5. Now, the world doesn't change because of that. What really helps is, and this is like my kind of message to all the, especially the first time founders or the young founders, uh, always try to have some you know founders who have been there, done that on your capital. Like when I was in private equity, I always felt like I have not been there, I have not done that, and that's why I felt so out of place. uh, and they would, the founders there would think, who is this guy, why is he asking these questions, right? But over the years we have earned, there is weight in what we say. There is history to it, there is learning from what we have done. So a founder who has been there, done that, is almost like your senior in your grad school. They're very precious. If you get the right seniors to be around, so many things become easier. When you're applying for a job, internship, whatever project, a lot of things they tell you what the prof is like. So we can tell founders how VCs think, how this VC is different from that VC. So now that is valuable. Or we can have these conversations like brainstorming sessions about product or GTM and all, which 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 founders struggle to have someone to have that kind of a deep conversation because uh, there are a lot of people who have not done that. They're good in other things, but here they don't have that. Um, and when it comes to angels, angels are busy building their own companies or doing their own thing. So they don't have the time or to really, while they have all the ability, but they may not have the time to give it to them. So we kind of fill in that spot. So at the end of the day, see, it's a market. Everything is a marketplace. Your network can only get you there. You are plugged in. That can only get you an introduction, but not nothing more than that. At the
Right.
end of the day, we have to offer something that others are not able to offer to the founders. And the word spreads. The bad word spreads faster. The good word spreads rather slowly. But eventually, it's my philosophy. Like it happens like gradually and then suddenly. So it takes
Yeah.
a while. Things, it doesn't look like anything is happening.
Yeah.
So on certain things, we are already on the suddenly thing because we have earned that equity over the years. On certain things, we are at the gradual stage but we are in no hurry. We are here for good, and we will
Yeah.
we'll keep building.
Absolutely. That's amazing. And now let's talk about what are the sectors that you're most interested in as an investor. You've you've built a startup in one sector, and I believe you've invested in multiple others. So tell me, what are your favorite sectors that you look at, and maybe mention some startups that you've invested in those sectors.
Yeah. So honestly, we don't think like sectors. In fact, see, it's a founder's job to figure out where the opportunities lie. And we are sitting much downstream in the whole thing. We are not right there, so we cannot choose the sectors either. So whatever the flow of deals is coming, we have to kind of act accordingly. So like in cricket, they say play the ball on merit. It's something similar here, that we look at a deal and we see how compelling the opportunity is. how compelling the proposition is, how deep the founders are thinking about it. Is the user really caring about it? All the things that, so it's a process that becomes more important for us, and that sometimes helps. Like there was this last year, there was this huge thing about AI, and a lot of money went into it, uh, and people kind of were still figuring out, kind of what will it become, and there was a lot of confusion also, but there was a lot of excitement also, and it confused us for a bit. And then we realized that kind of let's ignore all that. Let's see. Let's go back to the basics. Let's see. We invest in tech companies only. We don't invest in non-tech. So AI is also tech. You can call it tech 2.0 or whatever it is. And how do we think about tech is how do we think about AI? And the approach is that whatever it is it making the offering compelling for the user? Is it making the user pay for it, or those kind of things? Is the founder leveraging AI to solve a real world problem and kind of have a broad based solution around it, as opposed to, oh, this is cool tech. uh, and once you kind of get into that, probably, and we did, to your question that which sectors, we have invested like in 3 4 companies which are into AI, and we can call them as AI companies, or we can call them as, oh, this company is a company which is improving the earnings of QSR restaurants in US, and it's a big problem. Like they can kind of, they're using computer vision, they're using AI. That's incidental, but the problem they're solving is what it is. So as long as a startup is solving an interesting problem and they are chasing a profit pool, we are excited about it. And the way to think about it is technology, or whatever kind of hot sectors are there, uh, may not be as exciting, but the technology, when there's a shift in technology, that is very important because it opens up new opportunities. At the same time, founders cannot be thinking, okay, this is cool technology, let me build something about it. At the end of the day, it has to go back to, a business cannot be built without a product cannot be built without offering, and offering cannot be built without a user. So it all boils down to the user only. So it has worked beautifully for us, and we're just trying to kind of sharpen that thesis, as we go along.
Absolutely, that's a great strategy there. And you've built a startup in this in India, right? And you're now investing back in the country's startups, right? So, how do you look at the current startup ecosystem in the country, especially in maybe a downturn that we are in right now? And how do you
Yeah.
see going forward 10 years what it will look like?
So that maybe there are two aspects to it. How do I think like a founder? I'm still building. So in terms of the opportunity landscape, and how do you think like an investor? Uh, See, for founders, it's an amazing opportunity because the hardest thing is adoption. Whatever we are doing, and because of COVID, because of demonetization, because of geo, because of UPI, whatever you say, India has really got tech adoption at the grassroots level. And we are not talking about WhatsApp good morning messages. We are not talking about YouTubes and shorts. What we are talking about is transaction happening. And we are seeing this across sectors, kind of in mutual funds adoption, the fintechs are leading the way. All those things are happening. So really at the grassroots level, people have bought into this thing that, okay, transactions can happen online, money flow can happen online, and they're getting comfortable to that. And then there are so many companies which have become really large, the Paytms and the Phone Pays and Flipkarts, and also they have got this distribution also in a way sorted. Now it's not easier. It was very expensive for kind of Paytm to acquire those users and train them and educate them, all those things. But all that has happened. Now it is about building layers on top. And my earlier, I was in infra, so it's infra is the hardest part. Like when you build that infra, building the road, then building a service on top of it is easier. Building a service on top of services is becomes keeps becoming easier. So and it's a derivative kind of a thing. So it's faster also. So I feel from founders' perspective, the hardest thing has happened, which is tech adoption. Also, building is becoming easier. First, AWS came and changed it. Now, co-pilots are changing it. No code, low code. Tech is getting commoditized. 10 years ago, you cannot start a company without a tech co-founder. Today, I think it is very much possible because it's a product guys who are really kind of someone who has deep understanding of the user is what really counts. Technology is unless you're doing something deep tech, obviously that's a very different skill set, and you cannot just randomly come and pick it up. But for a lot of things which is about workflows and kind of basic tech, it's getting commoditized. So for founders who have business insights, who have user insights, this is an amazing opportunity. Looking at it from investors' perspective, if you see the different asset classes, gold is at pretty much on the higher side. Real estate over the last few years has really gone up. Public markets are trading at the highest. Even the late stage startups are kind of still sitting on their 2021 valuations, which we knew were on the higher side. And we want to invest in late stage and secondaries and all. We are not able to do that because we find them very expensive. I think the early stage startups are very good, at a good space because there's no baggage. These startups are new. They're not carrying the baggage of the last value around valuations. They're coming in with a lot of intent. They know the funding environment is not the most conducive, but still they're coming. So the intent is really high there. They're they're having the learnings of the last bull cycle, and they are building products which are more capital efficient. And also somewhere kind of most of the investors is this is we are calling it funding winters for a reason, that most of the investors are kind of staying away from it. So from an investor standpoint, it is a great opportunity to come into early stage companies. And we could be wrong, but our belief is like today we are all agreeing that 2021 vintage was expensive vintage. Probably in 3 4 years we'll say that okay, these are the times when someone should have been like, as they say that you should be greedy when others are fearful, and you should be fearful when others are greedy. uh, this is the time to be greedy and kind of invest in more companies, and that's why we invested in 20 companies in the last 1 year, and three of them have already done up rounds, and we didn't have that window. Also, a lot of these investments happened in the last 3 4 months, 5 months. So we already have three up rounds. There's a company we invested at $2 million, is raised at $5.5 million. Another one we invested at three has raised at five, and one more has got an up round wherein we are at 1.4x. So, and this is just beginning. I'm not saying kind of this will happen, but the quality of investors, quality of founders that we are getting, the quality of companies we are getting, and the lack of competition from most of the people is great for us. It's great vintage.
Absolutely, totally agree. So it's great time for early stage investors, but as early stage investors, you have to also think about the subsequent rounds that these companies will need to raise, right, in
Absolutely.
future. So how are you evaluating for that? That will this company with this amount of capital that I'm giving them be able to in future get to that level of traction that it will attract maybe seed stage funding or Series A funding, right? So
Yeah.
how are you looking for that?
Yeah. So one is we have done even Series A. We have done, not like we have led those rounds, but we have participated in those rounds. In Series B, we have done a very late stage company also, which could go public in 2 years. So we are across the board. Just focus is more on early stage because the pricing is better. See, at the end of the day, that's where you need. It is not about absolute that the company is great. Doesn't matter if the market doesn't believe that it is great, or if it is not able to raise the next round because everyone is fearful. You may still go wrong. So one needs to read, how others are, how the next stage investors are thinking about it. There is, it's not that people don't want to invest. Maybe at that stage, the companies already are or got corrupted with extra capital, and they're finding hard to kind of back those companies. But if we are seeing something which is capital efficient, which is kind of doing the line of current sentiment, uh, then kind of there is a lot of appetite for that. And to my mind, what has changed is, see, we will go back to that phase. At some point we'll talk about growth at all cost, and all those things will again happen. It's not that this is not a bug that there's a winter and there's summer and all. It's a feature of this is a cyclical industry. That's how it is, and that's how it corrects itself. It is important for it to be like that. And but it's a pendulum. It overswings on one side. It doesn't kind of. So now my belief is that there, there are three places where the capital goes when a startup raises capital. They spend money to build a good team, and that is a function of the surface area of the business and the number of moving parts. Now, if you're picking a very big surface area, you can't do much. You have to have a bigger team. I think those are the companies which are not getting a lot of traction because, again, they will need more capital. Second is you lose money at the unit level. Your gross margins are negative for whatever reasons. Again, kind of maybe at a very, very small base, that is fine. But fundamentally, that is not something people are excited about. And the third is your CAC. When you acquire a user, you end up spending. Now, what the market is creating a forcing function for startups, for founders, and they have to kind of reconfigure their thinking for that, right? So the choice of categories that we are focused on, or what founders also should be focusing on, are where the surface area is minimal. There are not many moving parts, so that you can, with a small team, you can create a lot more value. You don't need to have 1,000 people or 100 people or whatever. That's a choice of category that changes. It's not that the startups are not fundable. It's just that you have to focus on a certain different set of categories. Second is you have to create pull in the product. You cannot just throw money and buy demand. You have to create that pull in the product. So your CAC, people are okay to pay for CAC, but it cannot be anything. It has to be within a range. And over time, the CAC it should not be a business where as you grow, the CAC keeps going up, which was the problem in last bull cycle. You have to have something going which kind of reduces your CAC over time, or at least something like that is in the roadmap. In gross margins, little bit negative margins early on is acceptable. But if you're completely saying that, okay, I'll kind of subsidize demand and I'll become big, and once I'll become big, then I'll kind of rule the world, that today nobody has the appetite. So if you understand these things, then honestly speaking, with very little capital, you can build beautiful businesses. And it's not that these businesses are less aspirational. The problem is that suddenly what happens is that people stop being courageous, people stop being brave, they stop being aspirational and ambitious. It's not that. It's just that you have understood what the market is, and you have used that constraint to build strength in your product, to build capabilities into product, such that the users are more willing to pay, the CACs are lower, and all those things. And when the market turns, when the capital becomes available, you can use that capital. By now, your funnels are optimized and all those things, and you can just go and use that capital to kind of grow much faster. So it's not that these are uh, trying to be small companies; they're trying to be big companies, but they are just more real to the times. And you should play the market if the capital is available. See, I can't find fault with the founders and who raise a lot of capital and try to grow very fast in 2021, because if you don't do it, your competition will do it, and you will become inconsequential. So it's very easy for us to say that, oh, you didn't build a good business, you went all over the top. But that is how the market was forcing them to behave. But today, the good thing is that market is forcing them to behave enough, to build something which is fundamentally strong. And this is good foundation. If this is the foundation, then over time, kind of they will be able to they're better equipped to use capital when it comes along.
Absolutely. Yeah, I absolutely love that take about how founders need to play the market, and different markets require different styles of building, as you mentioned. And when you get that learning as a founder, then you understand that, okay, it's not a difficult market, it's just a different market,
Absolutely.
and there's a different way to
Exactly.
play,
Exactly.
right? Awesome, awesome, awesome. Now I'll go for the closing questions now, wherein I'll ask you five quick questions about the fund, the investing that you're doing at Misfits, and you can give me five quick
Sure.
answers, right? Right. So, what's the typical stage of investment where you come in?
So as of now, we are coming very early, uh, but we are not leading the rounds. So, but we are not focused on if the timing is right, if the opportunity is right, we can do late stage, secondaries, whatever. We are not fussed about that. But currently, the market is forcing us to come in early.
Great, and you're sector
Yeah,
agnostic,
absolutely.
right?
We don't do non-tech. We don't do much of DTC. We don't do Web3 because of regulation reasons, but mostly all tech we do.
Great, and what's the typical check size
So
you
we are
put in?
doing now 100, 150K in a company, but this is every quarter this is increasing. By the end of the year, we should be doing 300K in a company.
This is just your own money, or this is from the Misfits
Misfits
community and
completely,
members
kind of
as
putting that in.
okay, okay, great. Where can founders apply for funding in case there's a direct
Yeah, yeah.
line?
So see, the best is reach out to us on LinkedIn because that's where you can get to know what we are talking about. You can understand us better. We can also see what you're doing. We are very active on DMs and all. But you can write to us also at mike at misfits.capital. Mike is just a tribute to Mike Moritz, who is just one of the most phenomenal investors. Um, yeah, that's what it is.
What's the spelling for
Mike.
Mike? Can you spell it for us? MIKE at misfits.capital. Great. Where can our listeners follow you?
Yeah, I think LinkedIn is great. Look for Amit Singh Misfits, you'll find it. Um, yeah, I think I'm more active there than Twitter. Yeah,
Awesome. I'll make sure to put those links in
perfect.
the show notes below. Thanks so much for making time for this, and I wish
Thank you
you
so
happy
much, Prashant.
investing.
Was lovely and loved your question and that the way you are kind of pushing me on certain of those, some of those. Loved it. Thank you so much.
Thank you. Really appreciate it.